An individual may have received income from several sources in a year. Income of an individual that is chargeable to tax has to be classified under one of the following heads of income. Income from salary. Salary income refers to remuneration received from the employer for services rendered by the employee. In order to be treated as income from salary, it is essential for an employer-employee relationship to exist. Salary is taxed in the year it is due or received, whichever is earlier. Components of salary income include wages, annuity, pension, gratuity, retirement benefits, fees, commissions and perquisites, profits in lieu of salary, advances and allowance. Elements of salary income, which are exempt from tax, but only up to a specific limit, are taxed to the extent that they exceed the exemption available. Next is income from house property. Income under this head is taxable if the assessee is the owner of a property consisting of building or land appurtenant thereto and is not used by him for his business or professional purpose. Income earned from a house property is chargeable to tax in the hands of the owner/deemed owner under the head income from house property. It is therefore essential that the assessee should be the owner of the property. If a property is transferred to a spouse or minor child, without adequate compensation, it is not valid. The transferor is the deemed owner and income from property is taxable in his hands. The income that is taxed will be computed as gross annual value of the property less municipal taxes and unrealized rent equals net annual value less standard deductions and/or interest payable equals income from house property. Next, profits and gains from business or profession. The income charged to tax under this head is not the income from business or profession, but the profit or losses from business or a profession, after deducting allowed expenses. Income from business or profession carried on by an individual in a previous year, after adjusting for expenses, is chargeable to tax. Income under this head includes interest, commission, salary, bonus received or accruing, or profits earned from the business. The value of any benefits or perquisites arising out of income or profession is also charged under this head. From the income thus computed, expenses are deducted. The Income Tax Act specifically indicates the expenses that are expressly deductible, generally deductible and expenses that are not allowed to be deducted. Next, capital gains. A capital asset may have changed in value over time, leading to a gain or loss when it is sold. The profits or gains from the sale or transfer of a capital asset is referred to as capital gain and is chargeable to tax. Capital gains are charged to tax in the year of transfer. Capital asset includes movable or immovable property but excludes personal assets except jewelry, paintings, sculptures or works of art. Capital gains accrue when there is a valid transfer. This can be through sale, exchange, relinquishment of right, or a compulsory acquisition under law. However, transfer does not include the following: gift, transfer under a will or irrevocable trust, distribution of the assets of an HUF. Categorization of capital gains. Capital gains are categorized as short-term and long-term gains based on the period for which they were held before transfer. The tax treatment differs based on the type of asset and the type of capital gains. If the asset has been held for a period not exceeding 36 months, immediately before transfer, the gains, if any, is considered short-term in nature. Capital assets held for periods longer than 36 months is defined as long-term capital gains. In the case of immovable property such as land, building and property, the holding period for categorization as short-term and long-term is 24 months. For units of equity-oriented mutual funds, securities listed on a stock exchange, zero-coupon bonds holding period of not more than 12 months is considered for short-term capital gains and those held for more than 12 months is considered long-term capital gains. Next, income from other sources. Income that cannot be categorized under any of the other heads of income is accounted under this head. It includes the following: dividends, winnings from lotteries, races and other games of chance or skill, contributions received towards PF, superannuation, interest on securities, deemed gifts where the sum of money received without consideration exceeds Rs. 50,000 where the fair value of the movable or immovable property transferred without consideration exceeds 50,000 rupees. Movable property transferred with inadequate consideration, where the difference between fair value and consideration exceeds 50,000 rupees. Gifts received from specified relatives or on the occasion of marriage or under a will or inheritance is not taxed. The gross total income of an individual consists of the income under all the various heads. After arriving at the gross total income, adjustments are made for set-off and carry-forward provisions as applicable. Section VIA of the Income Tax Act specifies the deductions allowed from the total income of an individual. Such deductions are allowed only against specific expenditures and payments made during the financial year. Deductions allowable under the Income Tax Act cannot exceed the total income of the individual. If you want to do your financial planning, wealth management, portfolio analysis, or you want to start SIP, then you can contact us at 9,663,393,794.